This is Mark from TradeInform.com, and in this video I'm going to show you how you can combine volume and price to improve your trading results. In poker, there is a theory of table selection, and this theory states that your skill level is only one part of the equation. The other part of the equation, and in fact maybe the greater part of the equation, is the skill level of the people you are playing against. So to maximize your chance of winning, you should always be playing on the weakest table that you can find. Now this is an analogy, and poker is not trading the financial markets. If you are trading big markets with lots of liquidity, you will not find a weak table. But what you can do is choose tables that will suit what you are trying to do and give you a better chance of success. And what I'm talking about here is the power that every trader has, and that is the power to choose when and if you make a trade. To go back to table selection in poker, anytime you enter the market, you will be playing on a slightly different table. Get different groups of traders and investors with slightly different aims and access to slightly different information. You may have heard the quote that amateurs trade the open and professionals trade the close, but this of course is an oversimplification. Professionals and profitable traders will trade any time where they think they have a better chance of success. One way to understand who is at the table at the same time of you is to look at volume. And in this video, I'm going to show you some quantitative analysis that will help you answer the questions of when to trade, when not to trade, how long to hold your positions for, and when to increase your position size. On the screen at the moment is my analysis into volume and price, and I'm going to go over these settings soon. Now the first thing to note is this is a TradeInform backtest model, which is a way of doing all sorts of trading strategy analysis, and there is a link on the screen if you'd like more information about these models, and below the video. Now, the first way, I've measured volume in 3 different ways just to get some comparison to make sure that it's just not one single way of doing things. So the first way I've done it is 2 consecutive bars of rising volume. Anytime we have 2 consecutive bars, enter a trade, and I'm closing the trade after just 1 day, analysing the SPY ETF here. Strategy 2 is volume stochastic. Now volume, the stochastic oscillator, is a way of measuring momentum. So volume stochastic crossing above the 50% shows we have rising momentum in volume. And third and final volume strategy is enter anytime the volume is above its 10-period simple moving average. And finally, I have a scenario which compares entering the market, providing all the other conditions are true. Right, now the first filter I'm going to apply is the linear regression. Now, why I'm using this, the linear regression is the best fit straight line through a series of data, and I'm using this as a filter to identify bullish conditions. I'm using a 20-period linear regression. I'm trying to identify bullish conditions, so whenever the line is sloping upwards. We can see here it doesn't make a lot of difference to strategy number 1. Strategy number 2, I'm keeping all of the things the same here. Strategy number 2 is coiling closer to the best fit line on here, with a slightly higher expectancy per bar. And similar story for strategy number 3. So we have decent net profit in each of them. Although over the time period, it's nothing special, but we're only opening a trade for just 1 day. If I look at without the volume entry, in fact, we've got a fairly smooth upwardly sloping line, but expectancy per bar again is lower than in each of the 3 volume scenarios. Okay, now the next factor that I'm going to adjust is another filter, and this is minimum consecutive negative daily closes, which is simply a way of saying that the market needs to have closed down for at least one period before a trade can be entered. If I select this onto 1, which I'm doing now, we're going to have a look at how it has affected all the markets. Again, very little difference to strategy number 1. Look at strategy number 2. This is the stochastic crossing above. We have a higher expectancy per bar. So we have fewer trades, but a higher expectancy per bar. Strategy number 3. Again, we have a higher expectancy per bar. Percentage of winning trades, 60%, which is pretty decent. Quite a bit higher than the random entry. If I was to look at the control scenario here, we can see expectancy per bar is actually no different. So volume appears to be a factor in this scenario. Now the next thing that we might want to do is increase the length of time that the trade is open for. All things being equal, you want your trades to be open for as short a time as possible to reduce market risk, get the maximum profitability from your edge, which existed at the time of opening. Inevitably, you're going to have some decay over time. So I looked at for 3 bars. I'm keeping the linear regression filter on for the time being. As expected, we've got a higher net profit because trades have longer to go. Because we've identified bullish conditions, we would expect on average to have a slightly better chance of the market rising. Again, higher net profit, decent expectancy per bar. So each trade is staying open for an extra 2 days, 2 bars. So holding up our expectancy per bar means our average trade expectancy is good, just under 0.29%. Now, entering anytime volume is above its simple moving average. Expectancy per bar is pretty good, and we have the highest of the net profit of the 3. Let's look at our control scenario again. And we can see this is pretty good. So just opening it for 3 days, and expectancy per bar not as good as the volume scenario, but I do like the way that it is holding around its best fit line again. So we've got a decent percentage winning trades. We've got low drawdown, certainly compared to the market, and a decent annual growth rate. Okay, so let's look at if I were to, let's go back to our volume scenario again. Let's look at number 1. Let's see the advantage of staying open for a longer period of time. So let's double that to 6 days. See, we actually get no real advantage. 10 days. So again, we're not getting much advantage. In fact, the average holding period is not increasing as much as 10 because the trade is being closed by other means. I've got a trailing stop in the market here. Let's just set that to 1 or 2%. See, we're not helping at all there either. Now let's have a look. Keep it at 10. And let's have a look at strategy 2. Now you can see here, net profit has definitely increased. Average holding period is out to 6 days. So just over a week of holding period. Net profit's increasing, and it's holding pretty true to its best fit line. Last one here, the volume, anytime it's above its simple moving average. It's not responded as well as the stochastic entry. If I was to increase this to 20, you see we do have a decent net profit, but not a significant increase. Okay, so we've tested all of these scenarios. Let's test the basic entry here. You can see we really don't have much benefit at all for pushing out the entry. I could put this to 50 and it wouldn't make any difference. I expect average holding period is just about pretty average. Expectancy per bar is lower than we would expect just through random entry. So no advantage there. Now we can change a few further things. Let's try getting rid of the linear regression filter. Is this helping us? Well, if I take this off and keep the simple entry again, we can see no, it's not. We can expect a annual growth rate 7.8%, 335 net profit, and a MAR ratio, which is always relevant because this measures the difference between annual growth rate and drawdown of 0.24. Now let's go back and look at our volume scenarios. We can see here that the longer holding period and the lack of linear regression does not benefit volume strategy number 1. It would be better traded with the linear regression. However, it does benefit strategy number 2. So what we're seeing here is good expectancy per bar, reasonably long average holding period, MAR ratio 0.41, which is getting up there into reasonable territory over, this is a 20-year analysis, compound annual growth rate of 8.7%. Strategy number 3, we've got the highest net profit we've seen so far, 545 net profit, $45,000 net profit, 10% compound annual growth rate. Drawdown pretty reasonable. We would like it a bit lower, but 24% over that time period is not too bad. And a MAR ratio of 0.41. So we have a reasonable start for a trading strategy, which is in the market for about just over 5 bars. Doing significantly better on an average daily close compared to the underlying market. And if we're measuring MAR ratio, we can see we're performing 4 times better. You can see the advantage of a lower MAR ratio illustrated if I'm to increase the leverage factor here. You can see we can get compound annual growth rate double there. Average trade expectancy stays the same because that is measured in terms of the underlying market, but net profit is considerably higher. And when I say increase the leverage, what I'm doing is increasing our position size relative to our capital. So each position size is exactly double what it was in the initial scenario. So a 3% stop loss, if that is hit, a 3% target, if that is hit, would be a 6% gain in our capital. Put that back to 1. Always worth looking at leverage when we have low drawdown so we can contrast across different types of strategies. Now, I've already shown you what this looks like in the entry with all the other conditions being the same. Now, the last comparison I'm going to look at here is how reducing the time the trade is open can improve profitability. So we've got here a close after 20 bars, and that corresponds to a holding period of about 6 days. Now, if I was to reduce this from 20 to 10, you can see our net profit increases and expectancy per bar. All things being equal, I want to hold the trade for as little time as possible. You can see at some stage there is a trade-off between the amount of profitability we get, and we can see our edge declining over time. So you can see maybe about 6 days or 8 days, even 10 days would be the best solution for this given historic patterns. If I was to look at volume above the simple moving average, take it back to 20, you can see we actually have a decline in total profitability, but expectancy per bar holds pretty true. In fact, we can take it to 6 bars and we'd actually get an increase in expectancy per bar. So So there you have it. I've done an analysis looking at volume and price. I hope you found this useful. If you did, please hit the like button. Please subscribe to this channel. And for more information about trading the financial markets, about backtesting, your trading strategies and getting more winning trades, please go to tradeinformed.com.